welcome to Peterson Wealth Services Point of View. I'm Billy. I wanted to spend a minute today just to talk about the long-term nature of the markets and how compounding returns can really benefit investors if they're willing to stick it out and ride through some of the ups and downs. When I got into this business 25 years ago, there was an article printed in the Los Angeles Times, and it said, "Jockey seeks thrills in the stock market." And so I always looked at that and thought, that's really not what I want to say to my clients. I'm not seeking thrills. Matter of fact, investing, as we've said before, shouldn't be a thrill. It should be more boring. It should be like watching paint dry in a lot of ways. The thrill seekers are the ones who usually end up getting burned because they're in and out, thinking they need to do something all the time. I want to just kind of circle this all around and talk about long-term nature of investing in good quality companies and what it can compound and what that can produce over the long haul. So right now in the news, you're seeing companies that have been announcing stock splits, and that's getting people excited. That's another thing that motivates people to invest, is they think more shares is going to be better for their investment. The case in point right now is Amazon. Amazon just announced a 20-for-1 stock split. So I want to go back and look at the history of Amazon and show you what those splits have amounted to, and then we'll take a couple of other case studies in 2 or 3 other companies. So follow me along in this diagram, and we'll go through Amazon. This is their symbol. We'll go through Amazon being a shareholder in the early days and holding it all the way through today. Amazon went public 5/15/1997. So May of 97, that was just a couple of years before, as we all know now, the dot-com collapse, the major collapse of almost all tech companies. So in the IPO price, Amazon went public at $18 per share. So I'm going to take an example here and assume that we were investors and we bought 100 shares of Amazon on the offering. So of course that would amount to an $1,800 investment. 100 shares is kind of the typical number, a round lot. Some people would buy 1,000 or more, but let's just stay with 100. Now let's go through this scenario of what happened to Amazon since its history. They've split their stock 3 times up to now. They had a 2-for-1 stock split. Then they had a 3-for-1 stock split a few years later, and then another 2-for-1. So remember, we had 100 shares. They split it once, so that it would turn into 200 shares, and then into a 3-for-1, so that would become 600 shares, and then again 2-for-1. Now again, we're sitting at 1,200 shares. Now, looking at the share price of Amazon today, or roughly the share price today, $28.50. It's closer to $2,900 today, but let's just actually use this and calculate the value per share times the number of shares, and I've already done this, so just bear with me. That's going to be $3,420,000. Remember, that's our original investment. We didn't add to it. We didn't do anything. We just allowed that to accumulate over time. Now, just because it went public at 18 doesn't mean that people who might have bought it later missed out and could never recover or never make that kind of a decent profit. Actually, Amazon dropped in the 1999 and 2000 collapse. It dropped below its offering price. And there's been many other opportunities to buy the stock over the years. So remember, investing can take patience. Now we're looking at a 20-for-1 stock split on Amazon. So if we had, let's just say we originally had 100 shares, and let's just use a round number of $3,000, okay, for easy math. 100 shares, $3,000 a share, $300,000 in value. Now it's going to split 20-for-1, so we're going to get 20 shares for every one. So what do we have now? We have 2,000 shares. Most people forget this part. We have to divide the price out by 2,000. So now we're going to end up a new share price after the split of roughly 150. So what's that going to equal? The same. So stock splits don't do anything for added value. It's not like there's some magic formula that takes the share value higher. What really happens is a psychological event. The share price usually goes up because more people want to buy it now. And there's some motivation behind the scenes. The board of directors is deciding to split it for other reasons, is because they would like to be added to the Dow Jones Industrial Average, which is the basket of 30 companies. It's a benchmark that's been around for hundreds of years. And it's the price limitations require companies to be at underneath a certain dollar value. And so at 3,000, they would not be eligible to be part of the index. At 150, they would. So this is going to allow Dow Jones Index to be owning Amazon, and many other companies who follow those indexes are going to have to buy Amazon to include it into their portfolio. So that could also drive the stock price higher. Just wanted to share with you the stock splits, the mechanics behind the split, and really why it sends it higher. It's mostly that mental game that people decide it looks cheap, so they want to buy it again. Let's go through two other companies that I want to share with you some examples of how they've done over time. Now, I'm going to talk about Home Depot, and another company that most people know about, and obviously most people have been in their stores and purchased things, but I want to talk about this, being an investor in the company. Back in the days when it went public in 1981, 9/22 of 1981, IPO, and the IPO was $12 a share. So of course that's $1,200 if we wanted to buy 100 shares on the offering. Boy, that would have been a profit. I promise you, watch and see what happens. The stock has split 13 times, 13 splits since its opening, since its offering to the public. Now, they're not all 2 for 1. Some were 3 for 2, some were 5 for 4. But safe to say, I've done the math on that, all the different splits. And at the end of the day, your 100 shares, after all splits would be incorporated, would turn into 100 shares, turns into 34,171.875 shares. All right, that's how many shares you'd have now after all the splits. Now, the stock is trading at roughly $320 a share today. So that math will tell us that our total investment is worth $10,935,000, $1,200. Now, there's some people out there who will tell you the stock market is stupid, it's risky, it's gambling, you should never do it, I've lost all my money in the market. I would encourage you to show me a piece of real estate or a piece of property where 1,200 turned into almost 11 million in that amount of time. Bring that to me because I'd love to see it. This is not something that you can do in many other places. The other thing that's even more exciting, in my opinion, is you also have a dividend. The dividend is paid by this company, Home Depot, $7.60 per share. Oh, and that's per year, by the way. So if we had this many shares and we're getting that dollar amount per share, our annual income on that investment is $259,706. And that's just like clockwork, sitting back and doing nothing. Now that's the ultimate retirement plan, when you can have that kind of production of income and not have to do anything to receive it. There's no work, there's no labor, there's no thinking involved. By the way, the dividend goes up every year. The share value or the dividend per share is usually increased every year by Home Depot. So that's just something that I wanted to share with you on the compounding power of owning good companies and leaving them alone and not worrying about the fluctuations, because of course there were wild fluctuations in those share prices over all those years. This isn't just hand-picking a few years and saying this might have happened if you were lucky. This happened for a lot of people who just bought and held. Here's my final example. Now this is the symbol, BRKA, for Berkshire Hathaway. There's two share classes of Berkshire, A and B. Berkshire Hathaway A obviously it's Warren Buffett's company. He's the one that found or bought the company in 1965. Berkshire Hathaway. He has two classes. The A share class is trading at in the thousands, in the tens of thousands. They've never split the stock. So thinking that you have to own companies that split to make money is false. If you'd have bought Berkshire Hathaway in 1965, the year Buffett took over the company, and held, let's just say you invested $1,000 in the company at that point in time. Take a guess how much that's worth today. You're probably wrong. It's worth over $30 million. $1,000 buying and holding, not doing anything but sitting back. Now, he doesn't pay a dividend out, but you can sell shares, obviously, to pull any of your profits off the table. Buffett, his whole strategy is what I followed my whole career. Buy and hold good companies. The largest company, or the longest held company in his portfolio, is Coca-Cola, K-O, Coca-Cola. Started buying Coke in 1998. So his cost basis in Coke now is $3.25 a share. That's what his average cost per share is. Now, Coke's trading a lot higher than that today. But Coke also today pays $1.68 a share in dividends. That's dividends per share. Now, think about this. If his basis is $3.25 on his original investment, and he's getting $1.68 on every share today, he's getting a 52% return on investment, on original investment, every year. Every single year. So that means he's doubling his investment every 2 years. That's pretty powerful when you think about it. And that's just buying good companies and holding them for the long term. I just wanted to share with you some of those insights and take a trip back in time. When I started in this business 25 years ago, I didn't dream of, still standing here today, managing the kind of money we manage here at Peterson Wealth Services. But we've done it through the thick and thin, through the ups and downs, by buying companies like these, owning them for the long haul, trying to keep investors calm through the storms. And that's what we're dealing with right now. The situation's beyond our control, people getting anxious, excited, worried. We need to just focus on what we can control, which is buy when you can, add money when you can, when they think the values are there, and don't worry so much about the day-to-day. Things will work out in the end for most long-term investors and most good companies. Thanks for tuning in. Love to hear your thoughts, and take care out there.